What really is the state of the economy right now, and which investments will likely outperform in 2023 and beyond? We're here to discuss this and examine these themes with Kevin O'Leary, chairman of O'Leary Ventures and one of the stars of Shark Tank and Kevin's new show, Money Court. Welcome back to the show, Kevin. Always good to have you.
Great to be here. Thank you so much.
Your new show, tell us about that. You're co-hosting that with Bethany Frankel?
Yes, Bethany has a huge following. A lot of people know she made $100 million selling Skinny Girl, so she's quite an entrepreneur. Basic premise of the show is, 64% of business in America, small business, many of them family-oriented, but generally that's the backbone of the economy. There's a lot of disputes that have occurred during the pandemic. 3 years of lockdown caused havoc in small business. So there's a lot of litigation out there. A lot of these companies can't afford to go through the courts, so they come to Money Court. We arbitrate these cases, and they're fascinating. Basically, they agree for Bethany and I to look at the situation and come up with a solution to their problem or their potential litigation. And what ensues is a pretty incredible moment, many moments of amazing TV.
Okay, well, we'll look out for that. Very interesting premise indeed. Kevin, let's start with an overview of the macroeconomic landscape before we drill down to specific sectors that you like and perhaps don't like. People want to know from somebody who's working on the field in many different sectors that you've got investments in, what it's really like out there. Forget the print from the BLS, forget economist forecast for now. What does Kevin O'Leary think? I'm going to bring up one indicator that may mean something, may not. I know you like watches. So here's a story from Bloomberg, actually, from October 2022. Rolex prices to drop further as supply surges, says Morgan Stanley. I'm just going to read a paragraph of this. Prices for the most popular pre-owned Rolex, Patek Philippe, Audemars Piguets will fall further as the market has been flooded with supply, says Morgan Stanley analysts. After surging in 2021 and during the first quarter of 2022, an index of the most popular models from Daytona chronograph maker Rolex tracked by watch charts has fallen 21% since the market peak in April. Prices of the most popular Nautilus maker, Patek, has also fallen by about 19%. So high-end watches are falling. Is this an indicator of anything to do with the economy, or is this just sector specific to watches?
Well, I'm familiar with that index. I'm also familiar with that article. But what it doesn't point out is the 36 months prior, you're up about 400%. So The actual index is down about 28%. So if you were investing in watches over the last 36 months, you've beaten every index, including the S&P. And so it's still my best performing asset class. But what I find intriguing when people talk about Rolex being the biggest brand, the largest manufacturer, the most units, walk into any boutique anywhere in America, anywhere in Asia, anywhere in the Middle East, and try and buy a Rolex. It's true the secondary market has softened 28%, but there is absolutely no supply of new watches. And one of the problems, and this is across the entire Swiss, Italian, German, and Japanese watchmaking industry, is that we can't get young people to pursue the craft of watchmaking anymore. A new generation of watchmakers, very hard to find, because most young people that have to start this between 14 and 16 years old and dedicate your life to it, don't understand the need for a mechanical watch anymore. And so they look at their cell phone or their Apple Watch and say, this is more accurate than any Rolex is ever going to be. What do I need a Rolex for? So that has seeped into the market and is actually reducing the supply of watches. And again, prices are creeping up. One of the other indexes to talk about, and I'm glad you brought this topic up, is the Philips auctions that occur just for watches. The last one was in mid-December. I was very fortunate. I put up one of my Rolex Daytonas that had been used on Shark Tank for charity, and it went for a record price. And so there's nothing soft about the secondary market for fine timepieces.
Interesting.
And that was a very, very strong auction. And I also bought some pieces there at the top prices. I thought I could get them cheaper. It didn't happen. So be very careful about the assumption of just using watches as an overall index for the market. The demand is insatiable. They're still hard to get, and the supply is going to be continuing to be shrinking. So I think I love when we talk about this every few months, because I'm keeping an eye on it.
What are analysts getting wrong then? Because you're saying there's limited supply in the stores, and you're right. If you walk into an authorized dealer, you can't get a Rolex. But they're saying, and I'm quoting this article, the market has been flooded with supply.
I love that. I want to call that writer up and say, what are you talking about? Because that is complete BS. You cannot buy a Patek. You cannot get an Audemars Piguet. You cannot get a Rolex. You can't get an FP Journe. The waiting list for FP Journe right now is 2 years and 2 months for the lowest end models. I was just at the boutique here in Miami. I brought a fan in who begged me for a CB, a chronomètre bleu, the blue Putin watch. I took him to the boutique. He had to write an essay to apply for the right to buy one and receive it over 2 years from now. So I don't know what those guys are talking about. High-end watches are still better than gold.
All right. Well, we are going to talk about gold, your outlook for gold and specific sectors that you like. Just want to finish up here. So the supply issue that you're talking about, there's no supply. Is that because of supply chain logistic problems from either COVID or Ukraine war, or is that just a watch-specific sector issue that maybe they just have a limited number that they want to produce every year? Why is supply not meeting demand is basically my question.
Because growth in actual unit output in any maison, in any Swiss, German, or Italian or Japanese, Grand Seiko, for example, a huge Japanese brand, there's no year-over-year unit growth. Omega is now 6 months behind in releasing their new dials. They can't get the production out. They don't have enough watchmakers. I mean, Omega, the brand, has gone through the roof in recent times with drops like the Snoopy and what happened with the Swatch Group dropping all kinds of new Omega designs that were very, very popular for both men and women. And that's a remarkable story. You know, the James Bond watch came out of Omega. You can't get one. Go into the boutique. And so vintage watches are stabilized. They went down around 28%. They have stabilized for the last 4 months now, but there's no forecast for growth in unit output from any watchmaker this year. They simply can't get the labor.
Okay. Yeah. Your point about this issue not being an indicator for the economy. So demand for luxury goods, what are you observing right now? Up or down?
Up.
Discretionary spending overall is, yeah.
Yeah. I mean, the problem is the consumer is still flush with capital. Wealthy U.S. consumers, Asian consumers, Middle East consumers have an abundance of free capital. There is inflation, which makes them want to buy hard assets across the board, whether it be high-end pens, watches, cars, art. The auctions are still very, this is a very unusual recession, if indeed we are in a recession, because you've got so much capital still on the sidelines, over $4 trillion cash. So worldwide. And so, this is not your grandfather's recession. Plus you have full employment right now. And the Fed, the big debate is what is the terminal velocity of that interest rate? Is it going to be 5? Is it going to be 5.1, 5.2, 5.3%? We just don't know yet. Rates are down today after the latest data. So, there's a disconnect between the Fed pounding the table saying we're going to keep raising rates and what long-term bonds are doing. They don't believe them. And so, it's a very unusual situation. The Fed can keep making noise, but it's not working yet. And certainly it's a tight labor market.
The CPI data came out today. 6.5% was headline CPI. We're speaking today on Thursday. This has been on a steady downtrend since June, as you know. 9.1, it peaked. So now the question is, where is inflation headed next? Obviously, we're nowhere near the Fed's 2% target, but 6.5, you have to admit, anybody has to admit, looking at the data, is a big improvement from 9.1. Is that something you're looking out for? Are you concerned about inflation anymore, Kevin?
I'm always concerned with the Fed's doing. I can only watch what they do and then try and determine how I'm going to put capital to work based on what they do, not what they say. Now, one thing about that data, that CPI data, and lots of other analysts are talking about this, the housing data has rolled over in there and it's not reflected properly in this CPI 6.5. The real CPI, if we actually were to take true pricing of housing in major markets in the US, whether that be semi-detached, rental units included, standalone homes, certainly office and industrial space, that has rolled over, and it is representing a too high an inflation rate inside the CPI because the data they use is 11 to 18 months old. So that's why you're seeing this disconnect in the bond market. Anybody that buys bonds, a fixed income balance sheet investor like me, knows exactly why these spreads have tightened, particularly on triple B credits. They don't believe that inflation is actually 6.5%. Inflation may be as low as 5% right now if we were to true up the data from the housing market.
Uh, do macro conditions, including rising interest rates, let's focus on interest rates first. Interest rates have been rising. Has that affected your capital structure decisions? How much debt and equity in proportion to each other you keep on your balance sheets?
That's a great question. I've still kept the ratio of 30% fixed income and debt to 70% equity because I find equity is still more attractive. The way I look at equity now for the balance of this year, anybody that forecasts past a year, I mean, I don't know how you can do that, but right now I'm assuming the Fed is going to slow down a little bit and probably not pass the 5% terminal rate. And while they wait and see what happens to the economy. So most companies are starting to really cut costs any way they can. But there's been so much productivity with technology over the last 3 years that they've been doing a very good job of that. So you're going to see some earning revisions at some point. I don't anticipate any expansion to PE because we're still sitting at a 17 PE. So I don't think that's going to go up. So I'm looking for companies that A, are cash flow positive, B, do distributions of profits. So in other words, they take the cash and they distribute it through dividends. Some of them will do share buybacks, but not now that's being taxed. I think the dividend is going to be more popular. And so you have to be doing that without taking on debt. So if you have a clean balance sheet, not too much debt, and you're distributing profits, well, that's a good place to invest because you can probably make 5%, maybe 6% on capital appreciation in the next year, and maybe 1.5 to 2% in dividend yield. So I look at healthcare sector, very interesting. I like commodities. I like gold right now. I've pulled my horns in a little bit on tech because those are still trading at over 20 PEs, which is expensive. And those stocks have already had massive corrections. Media stocks are really interesting. They're fibrillating right now because of all the streaming losses. But you've seen some recovery in those names over the last 90 days as people start to say, well, who's going to survive the streaming wars and who isn't? Because media itself is an interesting business model if you think that you can get direct to consumer. Disney is under scrutiny now. I own that name. Nelson Phelps has said he wants to be an activist. That's probably good for the stock. And so you've got to find these situations. So underweighting tech, not overweighting energy. I think energy's had a fantastic run, but I think you want to take a little bit off the table there. It's been a very, very good place to be last year. I don't think you'll get the same kind of returns this year. Finding those large cap names in the S&P that have strong balance sheets across multi-sectors that pay distributions, that's the play for 2023.
I'm going to come back to some of these sectors you mentioned, but just on the distributions and dividends, do you think we're at a point where the corporate bond yields are almost competing with dividends? In other words, you can get similar yields buying high grade or perhaps even low grade corporate debt and get perhaps the same or better return than a dividend.
It's been better than the last 2 years. Prefs, converts, bank loans, triple B and above, double B, single B and below. You can pick up anywhere from, call it 3.9 to 5.9, depending on duration and quality, which is not bad, which is why I say 30% is not a bad allocation. Cash right now on our cash desks, we have cash to put to work. We're picking up 3.2 to 3.8%. So it's a sort of see and wait. I have been going back into the crypto markets lately. Anytime Bitcoin drops below 17,000, I add to our positions there. Crypto is getting very interesting because we're finally starting to see the bear of regulation coming into play. And I think long-term, that's a good thing. These hearings in the Senate have really poked the bear, as I like to say. And I participated in the last hearings. And when I had a chance to talk to the people on the Hill, or the lawmakers, I sensed that they're frustrated now. They're tired of putting these hearings on every 6 months, every time one of these crypto company blows up and goes to zero. They're so unregulated. These unregulated exchanges are just, they're all going to go to zero. And what's going to come out of it eventually is going to be a regulated crypto market, which I think will be very interesting because there's real merit. I mean, crypto itself is not the bad guy. Crypto is just software code. It's not the software code. It's all of these rogue players and these unregulated exchanges and the issuance of all these meritless tokens, the token on the exchange, all of this crap, if I excuse my French,
yeah,
it's all going to go away. It's all going to go away.
I actually saw you, one of the clips of you making a testimony, doing your testimony with the hearing. But to your point about regulation, here's a counter argument that I've heard, Kevin, from somebody who thinks that regulation is not necessary. Now, the argument is that if you look at Bernie Madoff, for example, he was operating under the purview of the SEC. There were laws against what he was doing, yet he still got away with it. Regulation, like you said, software code is not the bad guy, but then regulators aren't the heroes either. How would you respond to that?
No, I agree. There's always going to be fraud. The problem is, let me give you an example. Let's talk about tokens based on, we don't even have to mention what exchange, but all the large exchanges, the unregulated global exchanges, incentivize account holders and users to buy their tokens to get discounts on trading fees. It's not new. It's been going on for years. And then they put them on their balance sheet at a ridiculous valuation. And if you look at actually who owns these things, 97% of them are owned by the issuer. You don't know who that person is because it's simply a wallet without a name on it. And the other 3% are valuing it at 60, 70, 80, 90, 100 billion dollars. Now, if there's a cash run, a cash call back to fiat, back to US dollars on $100 billion, you know that exchange is going to fail. And that's exactly what happened to FTX when a rogue player said, I've got $550 million worth of FTT tokens, and I want cash by noon in 3 hours. Well, of course they don't have 500 million cash. None of them do. And so at the end of the day, this is all something that can just be regulated out of existence. You can't do that if it's a very simple regulation. You can't do that if you're a bank. You can't force people to buy your shares just to open an account. That's ridiculous. Or incentivize them with discounts. That's illegal. All I'm saying is set some rules up, and I think this is going to happen. And I'll tell you how I think this plays out. A passport system is going to be launched by regulators in major markets, US, Canada, Switzerland, United Arab Emirates, South American markets. And they're simply going to say, look, if you want access to the fiat cash in the regulated bank accounts in this geography, in this country, in this market, you have to be compliant to this passport. And they'll all have the same rules. And if you want to operate, because remember, the one thing about Bitcoin is it doesn't trade in any one geography. It trades around the world 24/7. So if you want to trade it on an exchange in Abu Dhabi or up in Canada or in Mexico or down in South America or here in the US, you're going to have to be passported, regulated. And that way, if you go offside in any market, they'll pull all your licenses. And then you no longer have access to getting cash in and out of banks. That's how I think they're going to do it. I'm speculating when I say it, but I think you're going to hear more hearings in the Senate and more of this reining in the cowboy rogue nature of what this has become. It's got to end. People are tired of losing all their money. And frankly, I think regulation doesn't have to be, it's not going to change fraud. It's just going to make it much easier for people to understand what the rules are and get rid of the rogue players.
One of the theories as to why regulation isn't more robust right now in the U.S. is that the senators and the regulators and the people making the legislation aren't very knowledgeable in about cryptos. Was that your impression when you did your hearing, attended the hearing with the Senate?
That was my assumption, and I was wrong. Their staff have become very intelligent.
Okay.
The Justice Department getting far advanced. The SEC, they really understand what's going on. They just haven't had agreement on who the regulators should be. There's a turf war going on and who should actually regulate. But there will be some regulation. There's no question about it. And I think, the Toomey hearings prior to when he retired on Jan 3rd, and now it looks like Haggerty may pick up the baton. They see the merit of digital payment systems and cryptocurrencies, but they want it done in a regulated environment. And I think that will continue. And they'll continue to educate themselves, and the hearings will continue. But I think it's all upside from here. And eventually institutions want to buy this stuff, and they're not buying it yet. For all of the noise about institutions coming in, they own nothing yet. Zero.
I know nobody knows the answer to this question. The next question I'm about to ask you is there going to be another FTX? In other words, people are eyeing Binance right now. They're eyeing DCG. There's news coming out of the top venture capital firms in cryptos. There's news coming out of Binance. CZ was on major media being asked hard questions about his liquidity that he fumbled over. People are worried, Kevin. Are you worried?
I'm not worried, but if you're asking me, will there be another meltdown to zero? Absolutely. 100% it'll happen. And it'll keep happening over and over and over
You think people
again.
will learn their lesson by now? Why would it keep happening?
Well, all of these exchanges, all of them, all the unregulated exchanges are having massive outflows right now. The smart money has got the joke. They saw what happened in FTX. They're not sitting around for an explanation. And if you're not willing to be audited, and I'm speaking about any exchange, if you don't have an auditor, you don't want to be transparent, you don't want to disclose ownership, why should institutional capital stay there? Of course, it's not going to. And frankly, it's very hard to find an auditor that wants to touch this stuff right now because of an unregulated cowboy environment. It's all going to end. And yes, there'll be many more zeros. The only place I have any crypto right now is up in the Canadian market, which is 100% regulated. They have a broker dealer attached to an exchange regulated by the OSC, all kinds of rules. You can't commingle. It's called BitBuy. And I've got my money there. It's owned by WonderFi, a public company. I have lots of capital tied up in there. It's the only place. I'm not putting it in an unregulated exchange anywhere. Forget it. Never again. And they get audited up there. And so, frankly, if you're sitting around trying to get me to buy a token from an exchange to get discounts on trading, that stuff's garbage.
What if they have like an FDIC kind of regulation where you're protected up to a certain amount? Would that change your mind?
Well, that may happen, but it'll be the same rules. You're going to have to be a bank. I mean, Circle is pursuing that. I own a piece of Circle. I'm a shareholder. I own USDC. They have been very, very compliant. They're working with regulators, and I think that's a payment system that may come to the fore very quickly. And because they are willing to go under that kind of scrutiny. And I think we may have those rules one day. We just have to treat crypto like any other asset that's regulated. And I think that will come.
What is the future of money? Let's go back to the economy. There's this social media trend happening right now, division of money and state. A lot of people are tweeting this, people in the crypto communities as well. And what they want to see is a form of money used by the people, for the people, not with any government intervention whatsoever. Is that going to happen one day, Kevin?
No, it's not going to happen. The reason that won't happen is as long as you have a completely unregulated, decentralized version of money, you're going to have people ripping you off. And that's what people have got a taste of. There's so many rogue players that want to take advantage of people on these decentralized platforms. Doesn't mean decentralized doesn't work. It means we need to have much higher security at the wallet level, more transparency. In the FTX case, you can go to your account, you see nothing there. It got completely scraped. So nobody trusts these systems yet. They want regulation. They want transparency. They trust the banking system, not the crypto markets yet. And so this idea that, that you're for decentralized and you're a rogue cowboy and you don't believe in government works until you find out you lost $50,000 in your account.
I think that you're absolutely right. The counter argument to that is that people don't trust the government either. They don't trust the central banks to have disciplined monetary policy. You're talking about people ripping you off directly. Yeah, but the government's ripping you off through inflation. They've created this inflation, is their argument, by printing money and undisciplined policies. How would you respond?
Yeah, but it's true. Listen, people have that attitude. If you want, you can go live in a cave with your dog and a rifle and some beef jerky. That's fine. I choose not to do that. So what I do is that I play by the government rules and I buy assets that protect me against inflation, like watches, like gold, like equities that are profitable companies. I mean, that's what I do. And I think that those rules have been established for hundreds of years and they work. So we're in a period of inflation. You've got to actually adjust what you're doing with your capital to protect yourself and protect your buying power. I buy real estate as well. There's all kinds of things you can do, and you can do them in a regulated environment. I just think that this nascent crypto industry has ripped off so many people. I saw a stat the other day. In the last 36 months, 80% of the people that participated in crypto as investors have lost 82% of their capital. I rest my case, Your Honor. I think that's a horrible way to start. And I think we need a complete change in how people think about it if we're ever going to get the narrative back to a constructive one.
Well, how would you hedge against inflation or any erosion of capital? Let's assume that we don't get 2%, the Fed's target, anytime soon. What would you do?
5% weighting in gold. I have a 5% weighting in Bitcoin. That's actually been performing quite well, even with all of these scandals and everything else. I've got a large allocation to equities. no equity more than 5%, no sector more than 20. So it's very diversified. And I have a lot of cash on hand right now because of some sales I made last year before some of the taxes went into effect on share buybacks. So I'm actually shopping to put more money to work, and I'm doing it. Looking at private equity, all kinds of new alternatives are emerging. And so the whole idea is my job is to get up every morning and put capital to work and find the path of least resistance. My bogey is to make 6% a year. Doesn't sound like a lot, but it's not easy. And so when you think of a broad portfolio, to distribute 6% cash, that's not easy to do. But I've been very fortunate in the last decade or more, and I've been able to do that.
Have your strategies for investing in private capital and venture capital changed during an economic slowdown? Presumably the pitches you're getting have changed in nature, right?
Oh, yeah, no question about it. I'm only interested in companies that have a very strong ability to acquire customers profitably. That means they have to understand social media. I like consumer goods and services where they have hundreds of thousands of investors. I'm looking for companies that really understand their markets and are very savvy at marketing. Those are the ones that I do business with. And I'm kind of agnostic to sector. I do tech, I do consumer goods. I did cat DNA testing, just looked at another business for pet supplies. I mean, there's all kinds of things that I get involved in, but it's really about the operator and their understanding on how to acquire customers and sell direct to them. That's where the highest margins are. I'm not interested in just all retail strategy anymore.
You have a very deep understanding of both public and private markets, which is rare. But tell us your strategies for both. I mean, presumably you have less information with the private markets, especially if you're dealing with angel investing where you're dealing with a startup with no history whatsoever. You can't make decisions based on their financial statements. That doesn't exist. So when you're making a pick for a public stock, for a publicly traded stock, how does that differ in your mind to making a pick for a venture capital investment?
Well, venture capital investments have to be looked at from a 5 to 7 year period. There's no liquidity, and there's very often no distributions. However, I've been very creative using royalties, venture debt, convertible debentures, where I get a preference and I get a portion of the cash out of the company every year. That's basically, what I've been doing for decades, and I'm known as the royalty guy on that front, and I'm happy and proud of the structures that I brought to the table there, and they work for me. And my returns have been in the private side around 11 to 17%. I mean, that's not the best, but it's not bad. In public markets, there's much more liquidity and returns that you're trying to make 6 to 8% a year and distribute 6% cash. Most of the stocks I own are dividend paying large cap companies, although I do have 20% weighting in mid cap companies around the $5 billion market cap, but they all pay dividends. Everything that I have on the balance sheet drips cash, like a chicken on a spit, dripping fat. It's got to drip cash. And that's what I do. I'm the cash guy. And I believe in cash. You can trust cash. You can't lie about cash. And I like cash. So I try and keep myself very close to cash. It makes me feel warm and fuzzy.
But I think that's where the discrepancy lies, is that with a publicly traded company, you have more information to work with to determine whether or not that company is going to continuously generate cash for you. In other words, be cash flow positive. How do you make that assessment with a startup?
That's much riskier. That's why you need a broad portfolio. Generally, I'd put on 7 to 10 companies a year into our portfolio. We have close to 50 right now. And at any one time, some are going out of business because that's the nature of venture capital. And then a few of them, as is happening right now, are being acquired. Mm-hmm. So you're looking for those unicorns. You're looking for those winners. The average since 1950s, it's been tracking this data, is you make 10 investments, 8 of them are living dead or go out of business, and 2 become huge hits. I'm doing a little better because I have the advantage of television. So about 4 of ours are profitable, and we make all our money off the 4 out of 10. So about 40% are really successful.
Last asset class I want to ask you about is gold. You brought up gold, something you like, 5% weighting. You told me before you don't like the gold miners, so we won't go into that. You rather just keep management out of your decision-making process. But what do you like about gold right now? Gold has in the last year, this is a counter argument to people buying gold, gold has in the last year not really kept up with inflation. Sure, it's outperformed stocks. Sure, it's outperformed Bitcoin, but hasn't really beat that benchmark CPI. So what are you using gold for right now?
I use it as a governing vehicle. In other words, I have a 5% weighting in it. I have half of that, 2.5% in physical gold that I pay for storage, and I use various ETFs for the rest so I can rebalance every quarter. But gold, over a very long period of time, has proven to make very big moves in very short periods of time. You don't know when or why, but that's why I have it at 5% weighting. And yes, I don't own the miners because over a long period of time, 25 years, you want to get the idiot management out of the equation. All they're doing for you is mining it out of the ground. You might as well just own the commodity. Some managers are good at controlling costs. Most of them aren't. So why use them at all? Just let them do their work. Let someone else pay for them to hew it out of the ground, and you just own the commodity. I've never owned miners. I think it's, there's an old, what's the definition of a liar? A miner standing beside a hole in the ground.
I've never heard that one before. Okay.
Yeah, everybody says that one, but it's true. I mean, why bother? So, you don't have to own those stocks. You can simply own, and which I do, the bullion. And it's a 5% weighting, and I think it's performed pretty well up to expectations. It's actually come alive lately in the last year. Let's see what it does over the next 12 months.
Final question. I opened with your outlook on the economy by using watches as an example. Give us to us straight, Kevin. Is the economy really in shambles right now? Are we really headed for a very deep recession, or is that just fear-mongering from people in the media? How bad is it? Is it good? Is it bad? How do you feel? What do you observe?
Well, actually, nobody knows. The narrative towards a soft landing is now at 50% of the narrative you hear in analysts discussing the future, and they're trying to determine the next 24 months. I've never seen so much narrative towards a soft landing, which people claimed only 4 months ago was impossible. You never get it. Well, it seems we might be getting that. You just don't know. I think to stay the course is to assume that returns on markets will be muted more in that 6 to 8 period, that 6 to 8% that I mentioned, and that you want to be very careful. And this is a narrative that a lot of people talked about. Quality matters now. Speculative, unprofitable companies have been absolutely crushed. Those stocks are down 70, 80, 90%. I don't anticipate them coming back. People are focusing on what's real and what is actually going to make money. And every once in a while, you get a crazy story, ChatGPT, that discussion about valuation of $29 billion. Who knows if Microsoft does that deal, under what terms? It smells like a royalty deal to me that they're doing. I think they ripped me off from Shark Tank on that thing, because they're taking out all the profits and getting half the business. I like that structure. I should charge them a royalty. But at the end of the day, the markets are going to be far more muted, and you have to focus on balance sheet and quality, just like it was in the old days. And so we're back. It's a full circle. All the speculative froth is gone, and profit matters again.
All right. Well, certainly lots to look forward to in 2023. There's certainly lots to discuss with you next time I speak with you, Kevin. Thank you so much for coming on the show on Kitco. I appreciate it. I appreciate your time.
Thank you. Take care.
Take care to you too. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more. Don't forget to subscribe.